So I'd like to share with you some information about what you'll need to know about valuation analysts. There are essentially 4 valuation analysts that are approved by the SBA for preparation of business valuation report. If your buyer is going to be using SBA financing, then it's very likely that an SBA approved appraisal will have to be done by an SBA approved appraiser. The 4 valuation analyst organizations that are approved by the SBA to prepare business valuations include Accredited in Business Valuation by the AICPA, Certified Valuation Analyst by the NACVA, Accredited Senior Appraiser, and Certified Business Appraiser. Those are the credentials that you'll be looking for in a valuation analyst. Regardless of which one of those that you use, you'll need to know that SBA requires that the report be done according to USPAP, Uniform Standards of Professional Appraisal Practice. Any of these credentialing organizations or any valuation analyst with these credentials will be familiar with USPAP and capable of preparing that report. So let's look at what Uniform Standards of Professional Appraisal Practice require. All of these steps will be contained or performed by a valuation analyst preparing a USPAP report. But I'd like to draw your attention to the one that we're going to talk about extensively here in this video. All 3 approaches are required by USPAP. Now, what 3 approaches are we talking about? The 3 approaches we're talking about are income approach, asset approach, and market approach. All 3 of these approaches are required in a USPAP valuation, and no doubt that'll be the bulk of the report. Let's look at the income approach. The first element of the income approach is cash flow. So what is cash flow? Cash flow is the return on investment. If you buy a business for, say, $1 million, and that business has a cash flow of $200,000, the $200,000 in cash flow represents the return on your investment. $200,000 cash flow on a $1 million purchase, that's a 20% return on investment. The second element in the income approach is the multiple. Most businesses, small businesses, Main Street businesses, will sell for a 3 to 5 multiple of cash flow. The multiple is essentially the number of years that it takes to get your investment back. So again, if you had a $1 million investment and you're getting $200,000 return, it takes 5 years to get your $1 million back. That's a 5 multiple. So let's take a deeper look at cash flow. Everybody likes to know, how do I determine my cash flow? Determining your cash flow is actually somewhat complicated. We're going to go over most of the common elements. There are at least 50 other items that we look at as valuation analysts in determining what your cash flow is. But here are the most common items. It starts with the net income on your tax return. Then we normalize owner's compensation. So what does it mean to normalize owner's compensation? Let's say you're a sole proprietor. In a sole proprietorship on your tax return, there's no deduction for the value of your wages. So if the value of your wages in the marketplace, let's say we could replace what you do for your company for a $50,000 wage. If that's the case, then we take your tax return and we subtract $50,000 to reflect the value of the wage that you're providing to the organization that's not reflected in the books. And in another example, if you were a corporation and you were paying yourself a $100,000 wage, but the fair value of your wage was $50,000, we would do the opposite. We would reduce the expenses by $50,000, increasing your cash flow. The second item is normalizing self-charge rent. It's similar to owner's compensation in that if you own the building that your business is in, and you're charging yourself rent, we would look at what we think the fair market value of those rents are, look at what you're charging yourself, and adjust your cash flow to reflect the fair market value of those rents. The next item is discretionary items. Now most people I know, have discretionary expenses in their business. Discretionary expenses are those items that are legitimate tax deductions, but yet are not critical to sustaining the cash flow that we're talking about in your business. So let's say you have a shareholder meeting in your corporation every year in Hawaii. All the travel expenses would be a legitimate discretionary expense deducted because the purpose of the trip was for shareholder meeting and corporate business. But the fact of the matter is you could have had that shareholder meeting right there in your office, and none of those travel expenses are necessary to sustaining the cash flow that you have in your business. Therefore, we can look at adding that back, reducing your deductions, and improving your cash flow. Improve your cash flow, we improve your value. Depreciation, the next item on the list. Everybody has equipment, and when you buy equipment, you depreciate that over a number of years. You pay for the purchase price of the equipment in year one, but you take a deduction for some percentage of it each year over the upcoming years. The cash is laid out in year one, and all the depreciation is taken as a deduction on the tax return over several years. Since there's no cash flow actually represented there, we add back depreciation to get to the true cash flow. But then we turn around and we subtract the average cost of capital expenditures. And capital expenditures are equipment purchases. If we think that if we think that it's going to take $20,000 a year in equipment purchases to replace retiring computers or retiring tools or retiring machinery, then that's actually an expense that's needed to replace the equipment and maintain those cash flows. Now you've got the most common items, and you should be able to get kind of ballpark on your business cash flows for your business. So let's move on and let's look at the other item. Cash flow times multiple equals value. So the multiple is essentially the rate of return requirement, and it's developed from published market statistics. We start with the risk-free rate, or the riskless rate, which is essentially the 20-year government bond rate. Government bond considered risk-free, and currently, as of the making of this video, runs about 2.7% interest rate. We look at published statistics on equity risk premium, size risk premium for your size of business, industry risk premium, which is an addition based on the type of industry that you're in, company-specific risk, which might have to do with key man, and subtract the long-term growth rate to get to a capitalization rate. The capitalization rate is essentially the inverse of the multiple. So we look at how many years will it take to get your investment back? If that's 5 years, or if you're getting 20% of your investment back each year, then it's a 5 multiple. So if we developed the capitalization rate, the rate of return requirement, it came up 33%, then it takes 3 years to get your investment back, then it's a 3 multiple. If it takes 10 years to get your investment back, then it's a 10 multiple. So you get the idea there. What we need to develop is the second thing, the cash flow first, the multiple second, which is the rate of return requirement, and then we can get to the value of your business on the income approach. Let's take a quick look at one other concept regarding multiple. Here's a slide which shows the multiple for middle market businesses from 1997 to 2005. On the top here, we've got businesses with under a $100 million value, or let's just say a $100 million value for purpose of this slide. You can see in 1997, the multiple was 9.5 times cash flow. Whereas as you look further across on the slide, you can see that in year 2000, the multiple was 6.5 times cash flow. You don't really have any control over the multiple for your business or the capitalization rate. It depends on what the market is doing. And as you've seen in the stock market, markets go up and down, and multiples go up and down also. And so you need to be aware that the multiple is not under your control. The multiple is based on what's happening in the market. Again, you can see that by year 2005, where in year 2000 the multiple was 6.5, by year 2005 it had returned to a 9.5 multiplier. These are middle market businesses. Most Main Street businesses will get a 3 to 5 multiplier, whereas middle market businesses will get a 5 to 10 multiplier. Now let's go ahead and move on to an actual case study where I can explain to you how the income approach worked.